Hey everyone, welcome back to the Mortgage Guru podcast. It is July 15th. We are halfway through the month of July. We are well on our way into quarter three, second half of 2022. What a week it has been. What a year it has been. If that's not the biggest understatement, I don't know what is. But man, this week we saw the highest inflation print in 41 years, almost a record. The CPI inflation consumer price index came in at 9.1% year over year. And one of the core components of that index is housing. Housing was actually only showing a 6% increase, or the component of CPI was only showing a 6% increase for housing. But we know that's not true. We've got rents up near 15% year over year, and home prices up 20% in some places year over year. Although, like we talked about last week, we are actually starting to see those numbers roll over. And what I mean by roll over is the peak looks like it is in, and the near term or month to month rate of change is actually starting to decelerate in certain markets. Austin, Texas being an example, we're starting to see home prices actually crash. We've had a month over month number, roughly, I think 4% decline, which is one of the fastest in that market, even going back to the 2008 crisis. So here's the thing with inflation. The idea that most people have when it comes to a lot of different economic data, particularly inflation, because inflation is very real. We can feel that everybody is impacted by inflation, which is why it also has a lot of political consequence, which we're not going to get into on this podcast, but it is something that echoes throughout the entire economy. But what ends up happening is people try to or like to extrapolate these data points into the future. If anything, they like to extrapolate them into perpetuity, thinking that inflation is just going to repeatedly and endlessly be a problem, and things are just going to go up, 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 and up, and that's just going to be this some kind of permanent trend. It couldn't be more further from the truth, where the opposite actually tends to be true. And I've been writing about this, posting on social media. I might have even discussed it last week. But the real cure for higher prices is actually higher prices. Eventually, this escalating inflation component has such a profound impact on market psychology. We're already seeing that. The consumer confidence survey, or the Michigan Consumer Confidence Survey, is at a record low. So people can see this, they can feel it. We are all experiencing it in one negative way or the other. And eventually we start adjusting our lifestyles, our financial decisions around that. And you're already starting to see that. One of the key things to understand about inflation, specifically the CPI, it's a lagging indicator. Here we are, July 15th, and we're just getting June's CPI data. And so it's backward looking. And unfortunately, this is a data set that the Fed relies on heavily when implementing its monetary policy. Monetary policy can mean a number of things, but specifically for most people, we take that to mean raising or lowering interest rates. And I'm going to get to what that actually means here in a second, because it's very, very important to the discussion we're going to have today. But yes, as inflation continues to go up, eventually things start to break. Oil prices have a profound impact on the economy, and typically are one of the things that do trigger market crashes, because eventually people just can't afford to do things like heat their house, drive their car. Businesses start to get impacted, whether it be less spending, more fearful about the future, so they cut back on expenses, which ultimately includes employees and staff. And so we're just at the beginning of some of that impact. We're starting to see jobless claims tick up. It looks like a new trend could be forming. That is not a good thing. So the Fed is in this position where they're trying to dance around this idea of a Goldilocks economy when they've already completely screwed that up. Now, somewhat to the Fed's defense, we won't get too in the weeds on this, but the Fed doesn't actually print money, but they do print bank reserves. And banks have the ability to then lend against those reserves. Without credit creation, you do not have economic expansion. One of the reasons, though, we are seeing the hottest inflation in 40 some years is because of the fiscal stimulus, the stimmies, the PPP loans. And thank God we never actually got to this build back better idea, because inflation would have very quickly turned into hyperinflation, because that fiscal spending is true money printing. Now, the Fed does ultimately at some point monetize that debt when they do quantitative easing and they're buying government bonds and putting them on their balance sheet. Like I said, I don't want to get too in the weeds on this, but one of the reasons that we are experiencing the high inflation that we are right now is not necessarily because of the Fed. Well, perhaps it's in spite of the Fed, but the Fed certainly contributes to it. It's more because of the government spending. There was way too much money handed out for too long, and now we are dealing with the impact of that. So here's the thing. We've got higher prices everywhere, and the cure for higher prices ultimately is these higher prices. It's tongue in cheek, but what we're saying is consumers eventually stop spending, businesses start cutting back, and we're starting to see that as there are increase in layoffs and jobless claims. So eventually the economy heads into recession when inflation becomes too much to handle. And that is where we're at. Unfortunately, like I was getting into a moment ago, the Fed uses the CPI and other types of inflation data like the PCE, Personal Consumption Expenditure Report. These are backward-looking indicators. And we look at forward or leading indicators, we're already starting to see the economy has started to slow, and in some sectors quite rapidly. Now, the other areas that we can look at, what I want to talk about today, because it's an important function of what happened on Wednesday, which was when the inflation report was released, and that is the inverted yield curve, or yield curves in general, and how they work to forecast recessions. This is something I've been talking about for quite some time. It's I think one of my favorite indicators, because it's such a simple one and it's such a simple idea to really embody or represent how the credit markets actually work. And this was something I was pounding the table on in 2017 and 18 prior to us heading into recession in 2019. Now, we didn't actually contribute the recession at the end of 2019 and the beginning of 2020 to normal economic factors because of COVID, but the reality was the economy was already decelerating pretty quickly and we were headed to a recession regardless. So back to yield curve. So what a yield curve is when you're looking at bond yields, when you go, so imagine, try to visualize with me a chart. So the vertical axis known as the y-axis and the horizontal lower axis known as the x-axis. So on the horizontal axis, imagine time. So years, months, etc. That's what we're considering when we're talking about bonds. How long is the duration of that bond? Is it a couple months? Or is it a couple years? Or is it what we refer to as a long duration bond, where it is anywhere from 10 years out to 30 years, and in some countries, even longer? So when we go up the y-axis, the vertical axis, we're looking at interest rate or yield. And on a normal curve, as you go further out left to right, the slope of the line should curve upwards. And the reason is because as you go further out on the curve, as we say, or longer in duration, you expect to be paid more interest. You're taking more risk the longer you lend money to anybody, especially a government. So you would require higher interest rates for that longer duration bond. And that's what we normally see. Now, eventually the curve starts to flatten out and form more like a straight line. And in some cases, it actually inverts. And that flattening and eventual inversion of the yield curve is a result of investors losing confidence in the direction or path of the economy. And this is something we have been seeing all year long. The yield curve at different parts of the curve, whether it be 3-year and 10-year and 10-year and 30-year, and there's not a yield curve per se. You can, make various comparisons throughout various durations of different bond coupons that are available. But for the most part, the ultimate barometer, or the one that most economists and market participants look at, is the 2-year and the 10-year. So comparing those two has almost a near perfect record predicted recessions when that curve inverts. Now, the 2 and the 10 has inverted more than once this year, but right now it is the deepest it has been inverted since the start of the century, as early as the prior to the 2006 real estate bubble. So we are going back quite some time since the last time we saw a yield curve this inverted, basically around the tech bust. So the market, the credit markets specifically, are telling us all is not well, and that consumers as well as market participants are losing faith in the future outlook of the economy. And they're representing that and how they're placing their bets. More or less, they're putting their money where their mouth is. And so the reason why an inverted yield curve forecasts recession is because in the near term, the risks become much more uncertain versus the long term. Or in the case of what's going on with inflation, there's other types of response mechanisms that we expect to see, that it makes more sense for investors to pile into the long end of the curve or buy longer duration bonds. And as more and more investors make that decision, they rebalance, they sell short-term bonds or short duration bonds or risky assets like stocks, and they move that money and rebalance and pile into the long end of the curve for that risk off position for safety, because they want that cash flow during uncertain times, which it feels like, it looks like everyone thinks we're headed towards. As more and more investors are piling into those longer duration bonds, the price of those bonds goes up. This is law of supply and demand. There's less of a certain thing that everybody wants, the price is going to go up. Now, the important thing to keep in mind is the yield or interest rate on a bond is inverse the price. So as the price goes up, the interest rate or yield on that bond is going to go down. So that is what we're seeing here as more and more investors are piling into long duration bonds. They're pushing the price up of those bonds, and as a result, interest rates on those bonds are going down. Now, on the short end of the curve, we have the Fed talking about raising rates, and they're talking about raising rates to combat inflation. And as a result of that, the short end of the curve is selling off, because you don't want to be getting less interest in what the Fed is willing to pay overnight, which is what the Fed funds rate is. It's an overnight lending rate. It's what the Fed controls. It's the only thing they can do when they say they're raising interest rates. It's a market function as to how the rest of the credit markets respond, what other interest rates are ultimately set at based on this market activity of buying and selling bonds. So investors are selling the short end, partly because the Fed is going to raise rates, and they don't want to be in a bond that isn't yielding as much interest as a future short duration bond will after the Fed hikes. They also don't want to be in a bond that eventually matures or expires and then have to reinvest at a time when there's greater uncertainty, and longer duration bonds are much, much more expensive. So people to a certain extent, are front running where they see things going, as well as where they think things will go once the Fed starts instituting some of these policy decisions. And that policy decision most likely is a 100 basis point rate hike near the end of this month. The FOMC, the Fed Open Market Committee, they meet, they make these rate policy decisions. The one in July is on the 26th and the 27th. And it is expected, with good reason, because of the 41-year high inflation print from CPI, it is expected the Fed is going to raise a full % on the Fed funds rate. This is also almost unprecedented, as they haven't raised that much more or less since the beginning of when they've been using the Fed funds rate as a policy tool, which goes back to the early 1990s. I was sharing with a colleague the other day how fascinating it is to be living through this time. We are in one of the most complex and complicated economic environments that has ever existed, at least specifically in the United States. And when you would look at charts going back to the 80s, the 1980s was kind of this, moment in time you just looked at. It was almost the outlier, especially when it came to interest rates. And most people are familiar with stories of how mortgage rates were 15% and all these different types of things back then. But what will be really interesting is 30 years from now, I feel like people will be looking back at various data sets and charts. And now 2022 will be that next spike on the chart, or that another outlier that, people will reference as this extreme moment in time. And so it's quite fascinating to be living through that. But of course, it's quite difficult for most people to try to navigate that. And unfortunately, the same people who've caused the problems are the ones that most of the world is expecting to fix it. So it's kind of like calling the arson in to put out the fire. But here's the thing. We've got red hot inflation. There's no question about that. We can see that everywhere. But it feels like when you're looking at some of the forward indicators and some of the other data, that inflation actually has peaked. Even some of the things that were part of, response to what was going on in Ukraine. And obviously that Ukrainian war is still going on. That's still an issue. There's a lot of geopolitical factors involved. And at the start of that, we saw oil skyrocket. We saw the price of food like wheat skyrocket. All of those things have come back down to earth. And what's so crazy about the last 6 months is everything that we have seen happen since 2020, the V-shaped recovery, the skyrocketing in asset prices, every type of tech business you can imagine, cryptocurrencies, the commodity sector, gold, silver, everything has come crashing back down to earth to pre-pandemic, pre-2020 levels. So we can definitely look backwards like we do with a CPI print from June and be like, year over year, prices have increased dramatically. But it's most likely inflation next year will be negative simply because it's a measurement of rate of change. And we're already starting to see all of these different assets and all of these different asset classes crumble back down to pre-2020 levels, while the fundamentals of the economy at the same time are getting drastically weaker. And this is definitely a concern. So what we have right now is inflation cooking the economy. And the question is, will we be cooked well done to the crisp before we find equilibrium again, before things balance out? And with a 100 basis point rate hike from the Fed, all that does to market psychology is things are expensive, inflation is out of control, I'm not going to spend. And that's just going to continue to have this ripple effect. And I think more and more people are going to start to get laid off. Companies are going to start tightening up their belt the same way consumers have. And this is when the crash in the economy really, really accelerates. And it doesn't matter what June CPI print was, because in the moment, everything is unraveling. And as an economy crashes, goodbye inflation. So this is a real concern. I really think this is where we're headed. And the last sector to really start to feel the pressure of inflation and the pressure of the consumer's response to inflation is the housing sector, but we're starting to see it now. The sales volumes are dropping, and now in certain markets, we're seeing a rapidly decreasing sales price as well. So this is something to keep an eye on. One of the things that people don't realize that, it is part of an inverted yield curve. It is one of the, you could say, benefits of that, as more and more investors are piling into the long end of the curve. That also means investors are buying more mortgage-backed securities. Mortgage-backed securities are a securitized bundle of mortgages. And when investors buy into this package of collateral, housing collateral, they receive a bond. Not going to get in the weeds on this either, but there's different types of bond coupons that pay different interest rates. That ultimately is what drives mortgage interest rates. And I'll get more granular on this another time. I don't want to get into it on this conversation, but investors are now also piling into mortgage bonds for the same reason that they would buy a 10, 20, or 30-year treasury bond. As a result, the cost of those mortgage-backed security bonds goes up and the interest rate or yield goes down, which means in this environment, we're already starting to see mortgage rates decline. Mortgage rates, 30-year fixed mortgage rates, typically follow the 10-year treasury bond. The 10-year treasury bond, I believe, peaked weeks ago at 3.5%. Even though we had a 40-year high inflation print or 41-year high print, the 10-year treasury bond actually dropped another 15 basis points, 0.15. So we've gone in less than a month from 3.5 down to 2.9, which is approximately where it closed today. We're starting to see the exact same trend and reaction function in mortgage-backed securities and mortgage rates. So the question is, will mortgage rates decline fast enough as the economy contracts and potentially crashes in certain areas? Will interest rates on mortgages decline fast enough to provide support under home prices? Will buyers come back to the market because homes are going to become more affordable with lower interest rates and support where prices generally are right now? That's a question that remains to be answered. Personally, I don't think so. And a lot of these overinflated markets, I think, are in for a shock. And one of the main reasons is once you get into a place where there is so much fear and so much money flowing into the bond market for that safe haven, for that risk-off trade, and interest rates are going dramatically lower, people at that point emotionally want no part of making any big financial decisions. They certainly don't want to go out and buy a house as they watch things start to crumble around them. So it's a very fine line. It's an intricate dance between the economy slowing, the economy crashing in some sectors, the housing sector slowing, prices coming down, at the same time interest rates coming down, making it more affordable or making mortgages more affordable. Does that bring people back to the market fast enough to provide support under prices? In certain markets, I believe so. And the question certainly is, what markets are going to survive this better than others? And I think the key component is going to be migration. Markets like Florida and other tax-friendly states and more preferred climate states have had a lot more people moving to the market than supply can handle. And although in aggregate across the country, we're seeing a ton of supply coming on that also puts downward pressure on prices, in certain markets, there's just never going to be enough when the pace of migration is so high. However, the places where we're seeing net a negative migration, like California, for example, these are places that I think are going to come under the most pressure. Housing market's going to come under the most pressure as this recession accelerates, gets deeper, and potentially becomes very, very severe. That ripple effect will hit housing hard, and especially in markets where there's been a net negative migration out of the state. So look, inflation's red hot. But is that red hot inflation in the past? It seems to be when we're looking at some of the forward indicators like jobless claims. It also seems to be when we consider how deeply inverted the yield curve is, which has a near perfect track record of predicting recession. Recession is 2 consecutive quarters of negative GDP. The first quarter was negative in real terms. The GDP Now forecasting model suggests quarter 2 is deeply negative, around 2%. So very likely, statistically speaking, we already are in recession, but do we really need the statistics to confirm that? We can all feel it. We can all sense it. So the question is, how long and how deep does this recession get? And how does the housing market respond? I think interest rates are going to be going dramatically lower. Does this provide a support under home prices? That's the big question. Let's stay tuned. Thank you for joining me again for another episode of the Mortgage Guru podcast. Tune in next week, and hopefully we'll have more data to discuss and dissect. And hopefully this time it's a little bit more positive.